Assalamu alaikum. As many of you know, I recently created a course on halal investing. It's a paid course. Alhamdulillah, the reviews have been quite good, but many people have reached out to me and said they can't afford the full paid course. What should they do? Well, for those people and for people who just want to learn about halal investing, I created this video. I covered the essentials of halal investing with a concentration on stocks, how to think about different concepts related to halal investing, and I give you enough knowledge to start and get your toes wet. You can then use this momentum from this course to develop your halal investing journey in a way that maximizes your chances of achieving your financial goals, and importantly, in a halal manner, inshallah. If you appreciate these types of videos, please leave a like. It helps promote the video so more people can see it. If you're generally interested in halal investing and Islamic finance, I highly recommend subscribing to this channel and hitting the notification bell so that you don't miss out on any upcoming value. I'm excited to dig into this with you because all too often I've seen well-intentioned Muslims get frustrated by the outcomes that they're getting from investing. Today, the available content on halal investing is more plentiful than ever, which makes separating the wheat from the chaff more difficult than ever. Around every corner, you find multiple opinions, each making sense in their own way. It's not easy, but I know I can make your life easier with this course, inshallah. During this course, here's what you can expect to learn. Number one, we're going to start with planning our trip so that we don't let a lack of clarity ruin our chances of success. Number two, I'm going to tell you what you need to do in order to have the biggest cheat code in investing. That is, to maximize your chances of success. Number three, we're going to dive into stocks and understand what they are. Number four, we're going to address, are stocks halal to begin with? Number five, how to find the best investment opportunities. And number six, we're going to talk about where to buy stocks and how to keep our trading halal. But before we do any of this, we're going to start as any Muslim should start any endeavor, and that is by purifying our intentions. The Prophet, peace be upon him, said, actions are judged by intention and every person will be judged based on what they intended. So before we start, let's make sure we dedicate our efforts to the pleasure of Allah subhanahu wa ta'ala. This is not to say you can't have an immediate worldly goal. You absolutely can, and you should. What I'm saying is that if you peel back the layers of your motivation, the core should always be seeking the pleasure of Allah subhanahu wa ta'ala. And mind you, purifying our intentions has practical usefulness to it because remembering our core motivation provides a robust ethical framework for making difficult decisions. So if our core motivation for investing is to please Allah subhanahu wa ta'ala, then it hardly makes any sense to do something displeasing to Allah subhanahu wa ta'ala in pursuit of this goal. Alright, so now we've purified our intentions. Let's start with the first learning objective, which is planning our trip. Now, when asking for directions from an app, you'll need to provide two things: your current location and your destination. Just like you need these data points to plan out a physical trip, you need them to plan out a financial trip as well. In other words, you need to know where you stand financially and where you aspire to be. If either of these data points is unclear, you can't really be sure if you're on the right path or not. At this point, the second guessing and frustration and disappointment begin. It may sound basic, but this is way more common of a mistake than you think. And typically the planning stage fails for one of the following reasons. Reason one, you're not tracking your income and expenses. This is a mistake. Think of your dollars as soldiers under your command. You are responsible for them, and you need to make sure that none of them are lost unnecessarily. Not to mention, constantly having to do mental accounting to keep track of your income and expenses takes up valuable mental space that you could be using for something else. Reason number two is you're not tracking what you own and what you owe. That is your net worth. This might sound crazy, but it's quite common for people not to know exactly how much they own and how much they owe. Or at least the person might have just a vague idea of these numbers. This should be especially unacceptable for Muslims since the Prophet, peace be upon him, taught us that our souls are suspended after our death until our debt is paid off. Reason number 3, not setting clear goals. I want to be rich. I want to be financially independent. I want to retire. These goals are too vague. They're missing a timeline. They're missing a plan. Remember, the probability of achieving your goals is directly proportional to how clear your goals are. Goal setting may feel uncomfortable at times because your goals may seem out of reach, but at the end of the day, we're in the goal achieving business. We're not in the morphine distribution business. You need to be able to clearly communicate your goals to yourself and others if you want to have a chance at achieving them. If any of what I said sounds familiar, don't feel bad. I know tons of investors who have faced these problems. A good financial plan always has the same ingredients, and here's what it should include. Number 1, tracking your income, expenses, and your net worth. That is what you own and what you owe. So you have to answer the questions. What is my financial situation today? How many dollars do I have flowing in every month? From where are they coming? How many dollars are flowing out? Where are they going? And from this data, you can answer the question, do I need to increase my income? Do I need to cut back on certain expenses? And you need to answer the question, what do I own and what do I owe? You need to understand what you're working with because this will determine the scope of your thinking and will help you determine what goals you can achieve in what time frame. Luckily, nowadays, there are apps and tools that can make this process seamless after you get them set up for the first time. I personally use Rocket Money, which I link to in the description, but there are tons of others that are perhaps just as good. A spreadsheet can help if you want unlimited flexibility. If you leave your email in the link that I provided, I will send you a spreadsheet that I personally use. Number 2, setting clear financial goals. Do you want to buy a house? Do you want to retire? Do you want to save for your children's education? Use the SMART framework to articulate your goals. This means making sure that your financial goals are specific, measurable, achievable, relevant, and time-bound. So an example of a well-written goal is, I want to accumulate 10 million in halal investments within 10 years, enabling me to retire comfortably by August 2033. And here are 3 tips on how we can improve the planning process. Tip number 1 is have a system. Develop a process for tracking your income, expenses, what you own and what you owe, your goals, and your progress towards them. By having a system, you reduce the time commitment of tracking your finances and your goals since you're not reinventing the wheel every time you check in. Tip number 2, include near-term goals. Winning is addictive. Get your winning streak going by setting smaller, near-term goals and accomplishing them. Once you get a few small goals under your belt, you'll have more momentum to accomplish your medium and longer-term goals. Tip number 3 is to share your goals with someone you trust and respect. This person can keep you accountable and you can share your progress and celebrate your wins with them, which makes the journey more fun. Encourage honesty to facilitate deeper, more meaningful conversations. And while it's true that this planning work takes time, it's essential for long-term success. As the saying goes, sometimes you need to go slower in order to go faster in the long run. So now we have our plan in place. We know where we are and are clear about where we are going. In the next section, we're going to talk about what you need to do to have the biggest investing advantage. Markets are volatile. Historical data shows that the stock market goes through cycles of correction, on average experiencing a 10% decline every 11 months, a 20% drop every 4 years, and plummeting more than 30% at least once per decade. However, on average, the market is moving upwards 70% of the time. Meaning, if you stay invested for long enough, you'll almost always come out ahead. However, most investors shoot themselves in the foot because they don't do what it takes to have a long time horizon. They don't realize that having a long time horizon is the ultimate investing advantage. Entering the market with a short time horizon leaves the investor exposed to the risk of having to sell at an inopportune time. To have a long investment time horizon, you have to do the following before you jump in. Number one, earn more than you spend. Surprisingly, some folks need to be reminded that they should be earning more than they spend before they start investing. If you don't, you have to either boost your income or cut your expenses so that you are. Number two, set aside an emergency fund. Having a cash reserve to cover unexpected expenses keeps you out of debt and saves you from panicking at every news headline. I typically tell clients to keep 3 to 6 months of expenses in cash. By the way, if you want to schedule a one-on-one consultation with me to review your finances, you can do so using the link in the description. Number three, pay off your interest-bearing debt. Prioritizing repaying debt is both a religious and a financial imperative. It's a religious imperative because interest on debt, or riba, is haram. It's a financial imperative because the return from paying off debt is guaranteed. And your return every month from paying off interest-bearing debt is the interest that you don't have to pay. No investment can compete with the risk-adjusted return from paying off your interest-bearing debt, since all investments that yield a return have a non-zero amount of risk. Number four, set aside savings for imminent expenses. If you are saving up for a large purchase that will be due in the next 12 months, like a down payment on a house, set that money aside. Do not invest with it because the value of your investments may decline right when you need the money the most. So to summarize, in order to make sure you have the biggest investing advantage, which is a long time horizon, make sure you've done the following. Number one, earn more than you spend. Number two, set aside an emergency fund. Number three, pay off your interest-bearing debt. And number four, set aside savings for imminent expenses. This one advantage of having a long time horizon and never being forced to sell when you don't want to can make the difference between having market beating or market lagging returns. Not to mention, reaching these financial milestones will make your investing experience far more enjoyable. All right, so now that we have the ultimate investing advantage, which is a long time horizon, let's deepen our understanding of one of the main tools for modern wealth creation, which is stocks. On a fundamental level, stocks are fractional ownership shares of actual businesses, hence why units of stocks are called shares. The terms stocks and equities are often used interchangeably in the financial world, and here's why. In a broad financial sense, equity means an ownership interest in an asset. If you own a house, your equity in the house is the current market value of that house minus any debt that you may have against it. Essentially, it's what you'd have if you sold the house and you paid off the debt. For example, if the market value of your house is $1 million and you owe $400,000 against your house, your equity in the house is $600,000. It's the same with corporations, where the stockholder equity is just the total assets of the company minus their total liabilities. When you buy stocks, you are buying part of the company's stockholder equity, which is a claim on part of the company's residual assets and earnings. So what does stock ownership typically entitle stockholders to? Well, number one, dividends. As a stockholder, you can receive part of the company's profits called dividends, which are distributed proportionally to the number of shares you own. Note, not all companies decide to pay dividends to stockholders, and the ones that do currently are not required to continue to pay in the future. I've put together a portfolio of dividend-paying stocks, which I'm comfortable with from a halal perspective, and I think are promising from a financial perspective. I invest in them regularly and share my investments with PIF members. So if you want to learn more about this portfolio and other benefits of PIF membership, check out the link in the description. The second thing you get as a stockholder are voting rights. Owning stock typically gives you the right to vote on key company matters, such as electing the board of directors. Number three, a residual claim. So this is not that attractive, but If a company goes bankrupt and is liquidated, stockholders have a claim on any remaining assets after all debts are paid. However, common stockholders are last in line, meaning everyone else will get paid before the common stockholder will. Number 4, and this is the main attraction of stocks, and that is capital appreciation. If the company's stock price rises, you can sell your shares for a profit. However, this is not guaranteed, and stocks can also decrease in value. As an investment, there are many attributes to stocks that make them appealing. In fact, the rich have a particular affinity for stocks, with 90% of US stocks being owned by the richest 10% of Americans. Here's what makes stocks a particularly appealing investment. Number 1, multi-X returns are possible. If you invested in Microsoft in 1986, you would be up more than 2,500 times today. This means an investment of just $10,000 would be worth more than $25 million today. The potential to risk X and earn 10X, 100X, sometimes 1,000X is a very appealing dynamic that is seldom even plausible with other assets. Real estate, commodities, bonds rarely display similar promise. By the way, as a side note, bonds are interest-bearing debt, so don't just avoid them because of their historically very poor returns, but they're also haram. It only takes identifying one Microsoft in your lifetime to become incredibly wealthy. This is not to say that you have to risk your entire investment in one position to achieve amazing financial results. Here's a snapshot of the PIF growth portfolio in the first 6 months of 2023, which on average consisted of 8 different stocks at any particular point in time. Private company investments can sometimes offer comparable returns, but they lack transparency. This lack of transparency is the next appealing attribute of stocks, which is that public disclosures are required. Publicly traded companies are subject to strict regulations by entities such as the Securities and Exchange Commission, or the SEC, in the United States, and similar entities in other countries. These companies are required to regularly disclose financial statements like annual reports and quarterly reports and other material information that are designed to keep investors informed about the company's performance. Investors are seldom privy to these regular, reliably audited disclosures when they are investing in private companies. Number 3, inflation protection. A dollar today buys less than it did a year ago, and in all likelihood buys more today than it will 1 year from now. This loss of purchasing power is called inflation, and it refers to the declining purchasing power of money over time. The purchasing power of your money is like a melting ice cube when it is sitting idly uninvested. Investing in stocks is one way to stop the melting of your purchasing power ice cube. This is because historically, stock market returns have significantly outpaced the rate of inflation. A dollar invested in the stock market has grown faster than the rate of decay from inflation. For example, the long-term inflation rate of the US dollar has averaged around 3.1% annually since 1913. On the other hand, stocks have averaged double-digit average annual returns during this same period. So compared to just saving money, investing in stocks not only protects your purchasing power, but it grows it as well. Number 4, high liquidity. Liquidity refers to the speed with which you can convert an investment into cash. It doesn't get more liquid than pulling out your phone and selling a stock position in a matter of seconds. This is a real challenge when you're investing in other assets like real estate and private equity, where it can sometimes take years to cash out of your position. Consequently, your invested money may not be accessible to you when you need it. Number 5, easy diversification. Diversification refers to spreading your investment money over various investments to reduce the impact of any one position losing a lot of value. Many investors fail to recognize the significant diversification potential that stock investing offers. For example, owning 5 properties in a single city might seem diversified, but in reality, It's exposed to localized economic risks. If the property market in that city falls, it's likely that all of those properties will be impacted. On the other hand, with stocks, you can buy 5 different companies belonging to 5 different industries that are based out of 5 different regions of the world in a matter of minutes. So to summarize, as an investment, stocks have attractive attributes because 1, multi-X returns are plausible. Number 2, public disclosures are required. Number 3, they provide inflation protection. Number 4, they are highly liquid. And number 5, you can get some really easy diversification using them. So now that we know what are stocks and what makes them such an attractive investment, let's attempt to answer the essential question in every halal-conscious investor's mind, which is, are stocks halal? So as we learned, stocks are fractional ownership shares in actual businesses. So there's nothing controversial in Islam about buying shares in actual businesses, regardless of whether these shares are traded on public markets or not. So we can comfortably say that, in principle, investing in shares of businesses or stocks is not haram. That said, logically, there are instances where owning shares of a business can be haram, and these instances broadly include: 1, when the company is earning money from haram, obviously. Number 2, when the company relies on haram in order to operate, and most commonly this will manifest in a reliance on interest-bearing debt in the company's business model. And number 3, when the company's personality includes unethical behavior. That is to say, unethical behavior is either ongoing or it's to be expected from this company. And so we don't want to be part owner of a company where any of what I just mentioned applies. Why do we not want to own stock in companies where any of this applies? Well, companies sell stock to raise money. This money is then used for the development and growth of the company, or as a way for company owners to cash out their ownership positions. So we definitely don't want to support un-Islamic activities or reward its practitioners. Even after their initial sale, companies still benefit and care about their stock price for a number of reasons, including stockholders appoint the board of directors, who in turn select the company's management team, and therefore the shareholders are the de facto bosses of management. In order for management to keep their stockholder bosses happy, they have to ensure the stock price is going up over time. Number 2, company leadership often owns a lot of stock and is paid in stocks or options to buy the stock. And number 3, if a company's stock price grows, lenders assign a lower risk profile to this company, and they're more willing to lend to the company and offer it lower interest rates. So even after their initial sale, the company and its management still have a vested interest in ensuring that its stock price is constantly growing. Therefore, by buying a company's stock and supporting its price, whether this is at the point of initial sale or after that, stockholders are enabling and rewarding the company's business and its management's behavior. Accordingly, the halal-conscious investor should be cognizant of not doing this, let alone profiting from it. So now the question that suggests itself is, are any companies perfect from a halal perspective? And the answer to that is no. All companies will have some level of interaction with elements deemed forbidden in Islam, especially publicly traded companies, which are typically larger in size and have a wider variety of dealings than, say, your average neighborhood convenience store. At a minimum, all companies are going to keep their money in banks that deal with interest. Consequently, if we adopt a zero tolerance policy for anything less than perfect, no companies would be permissible or halal to invest in, which would cut Muslims out of investing altogether. This doesn't seem like an outcome that is in service of the greater well-being of Muslims at large. Therefore, some amount of judgment is required when deciding on the level of forbidden dealings a company can have before we are uncomfortable investing in it from a halal perspective. There are now some generally accepted industry standards with regards to screening for Sharia compliance, which I cover in more detail in my course. along with the system that I use for screening, but ultimately Sharia screening comes down to a judgment call. Now, keep in mind, the amount of impermissible activities that we should target for ourselves should always be set to 0. However, when we're dealing with things that are outside of our control, setting a 0 target is impractical. As an analogy, when you work for a company, you insist on not participating in any haram activities yourself. However, you may know that the company is involved in some haram dealings that are beyond your control. As I mentioned, at minimum, they're keeping their cash in an interest-bearing bank account. Cash, which, by the way, they use to pay employees like yourself. By working for the company, you are supporting the company in a far more profound way than a passive stockholder is. Dedicating 8 hours of work per day to a company is far more impactful to that company than simply holding on to shares of a company, which if you sold, will find a buyer immediately. So there's some amount of tolerance for impermissible activity by the employer, and for good reason. Without it, Muslims wouldn't be able to work for almost any company. Moreover, what is the alternative? Keeping your purchasing power in cash? It's no secret that the fiat currencies we use today are created through interest-bearing debt. At least shares of a company are created as part of a value-producing enterprise. So I think there's an argument to be made that keeping your money in stocks is more Sharia compliant than keeping your money in the fiat currencies that we are accustomed to today. Which companies have a level of dealing with haram which make them intolerable to work for and which do not is ultimately a judgment call that every Muslim has to make. And the same can be said with regards to which companies are tolerable to invest in from a halal perspective. The aim of my more in-depth course is to empower you to make these ethical decisions on your own and in an informed manner. So now that we've answered the question of whether stocks are halal to invest in, or at least I've given you my answer and how I think about it, let's talk about how to find the best stocks. There is more information, more signals, and more data sources to inform the investment decision-making process than ever before. Average investors get lost in the sea of resources, but the great investors adhere to a rigorous and objective methodology when evaluating stocks. Do you want to be great or do you want to be average? We're here to be great, inshallah. For those that dare to be great, here's how you can get started, and it's a lot easier than you think. The key is to exploit your edge. 70% of trades nowadays are automated. Sophisticated algorithms written by math and physics PhDs comb through mountains of data to make real-time trade decisions. Individual investors don't stand a chance trading against these algorithms. However, individual investors do have an edge over these algorithms in one area, and that is assessing the quality of a company's products or services. Your actual experience with a product or service is your edge as an investor. This experience cannot be appreciated by an algorithm. Investors who exploit this advantage will do well. Investors who ignore it are fighting a losing battle. My experience with the stock Eli Lilly is one example of this. I invested in Eli Lilly as part of the PIF dividend portfolio, and afterwards I was speaking with a PIF member, a physician, and he told me, I see you added Eli Lilly to our dividend portfolio. I think it's a great pick. You could probably consider it for the PIF growth portfolio as well. I asked him, why is that? He responded, I'm seeing their products prescribed more and more by fellow physicians who are impressed with their results. They have a lot of products that are increasing in popularity. About a couple of weeks later, Goldman Sachs came out with their list of most overvalued stocks. Eli Lilly was at the top of this list, and it was estimated to be overvalued by 20%. A few days after that, Eli Lilly reported their earnings, and they blew those earnings out of the park. The stock was up a further 20% after their earnings announcement. The physician I spoke with had a real edge over people sitting on Wall Street reading financial statements, and he used his edge to make an investment assessment that was superior to the hotshots on Wall Street who are paid millions of dollars for their opinions. So yes, individual investors can absolutely beat the pros, but they must exploit their advantage. So what does this look like? If you're a doctor, I'm suggesting your portfolio should be skewed towards pharmaceutical and healthcare companies, whose products and services you come into contact with and you're a fan of. If you're a farmer, you should own a lot of agriculture-related companies. If you're an engineer, engineering companies, and so on. Your circle of competence is your edge as an investor. And if you're aiming to beat the market, you have to exploit this edge. Now, your circle of competence doesn't need to be limited to just your field of work. Did you notice more Tesla vehicles cruising the streets a few years ago? Maybe your neighbors have been raving about their newly installed Enphase solar power system. When the pandemic started, did you notice your company was increasingly using this new video conferencing software called Zoom for all of its remote meetings? The real world is where great investing ideas come from. Not financials, not comps, and certainly not charts. The terrible losses in investing happen when physicians are heavy in the oil industry, and engineers are heavy in pharmaceuticals, and farmers are overweight cybersecurity companies. When individual investors forfeit their edge, they end up with poor returns. When they exploit their edge, they can do great. Now, once you've spotted a potential investment, it's time to build an investment case. I go through my process for building an investment case as well as analyzing valuations in more depth in my course, which you can sign up for using the link in the description. Now, the final part of this course that we're going to cover is where to buy stocks and how to keep our buying halal. So you're going to need a brokerage account in order to buy, sell, and hold stocks. And a brokerage account is just the type of account that is designed to hold cash and investments. Luckily, it's never been easier to open a brokerage account. And in most countries, there are a myriad of options to choose from. So how do you pick which brokerage to go with given all these options? Well, consider the following criteria when choosing your online brokerage. Number one, fees. The two most common are transaction fees. These are fees charged for the execution of a trade. Many brokers are now offering $0 trades. Number two, conversion fees. If you plan on buying stocks in international markets, your broker may need to convert your domestic currency into the currency of the foreign market to execute the trade. For example, if you're Canadian and you're trading on the New York Stock Exchange, your Canadian dollars would need to be converted into US dollars. Brokers usually charge a fee for this service. If these conversion fees are not mentioned explicitly, ask about them because over time they add up in a big way. Number two, account minimums. Brokers that do not require a minimum investment are ideal for new investors who want to start with limited capital. Number three, investment options. The scope of accessible stocks and ETFs can differ widely among brokers. Make sure the broker you choose has the stocks and ETFs that you're interested in buying and a broad selection of others. Number four, customer support. Beginners should prioritize platforms known for delivering superior customer support. This support can be invaluable when trying to figure things out. Number five, regulatory oversight. The most important consideration, in my opinion, is essential to verify that any prospective broker operates under the supervision of a credible regulatory authority. This step helps protect against fraud and the misappropriation of customer funds. Remember the crypto broker FTX? They were incorporated in the Bahamas for a reason, to avoid regulation. And once you've found a broker, do the following to keep your trading halal. Number one, only use cash accounts. Stockbrokers usually offer two types of accounts. The first is a cash account, which basically means you spend the cash that you have. The second is a margin account, which enables you to borrow from the broker. To keep your trading halal, only use cash accounts. Why? Because in Islam, there are only two types of loans. It's either a charitable loan, which is permissible, and then you have everything else, which is ribawi or forbidden. Given the for-profit nature of brokerage services, the likelihood of them extending a charitable loan to their customers is exactly zero. And whether the interest is explicit or implicit doesn't really matter. You can be sure they are benefiting in one way or the other. Therefore, any loans received from a broker to trade with are forbidden. The second thing to keep your trading halal is just avoid derivatives. While not all derivatives are haram, the majority are. Contracts for difference, CFDs, and binary options are especially problematic. Focus on stocks and exchange-traded funds instead and avoid derivatives. Now, on the topic of brokerage accounts, here are my top picks. Number one, M1 Finance. The advantages of M1 Finance include that they offer a portfolio view for managing your investments and rebalancing. And something I really like, and this is important for beginners, is that they discourage day trading by limiting the trade windows to certain times of day, either when the market opens or when the market closes. That is, the second window is only available if you have a premium subscription. The disadvantage is that it's only available in the US and only US stocks are available on it. My second pick is Fidelity. The advantages of Fidelity are that it has a simple platform, has great customer service, and minimal fees. The disadvantage is that it's available in a limited number of countries. You can check their website to see the most recent list of countries that they're available in. My third pick would be Interactive Brokers. The biggest advantage of Interactive Brokers is that it's available in a large number of countries, and it offers a very large selection of stocks from over 135 exchanges worldwide across 33 countries. The disadvantages are that their platform isn't really intuitive, and it's really hard for beginners to get used to it. I've linked to these brokerages in the description. There are plenty of other perfectly good brokerages to use. Now that you know what to look for, they are just a Google search away. Now, if while watching this course you thought to yourself, wow, this is really helpful, I would like to learn more about how to screen for Sharia compliance, analyze stocks, build investment cases, build and manage investment portfolios that are designed to accomplish my financial goals. If these topics are of interest to you, then I would highly recommend signing up for a more in-depth course. You can learn more about it using the link that I've included in the description. Alternatively, if you think you already know enough and you simply want to save time and effort investing, I highly recommend checking out our PIF membership service. We share our personal stock screenings, price targets, portfolios that we invest our own money in, so we have skin in the game. And with regards to investing, my advice to you is to get to it and to stick with it. Start small and start early so you minimize the costs of your mistakes and you maximize the value of the lessons that you learn. Make sure to leave a like if you found this course beneficial. Until next time, take care of yourself. Assalamu alaikum and peace be upon you all.